So let's post the first question, please. So the very first question here is, what percent of Southeast Wisconsin transactions over the past year were $1 million or over, okay? That came from outside investment money. So what percent of investments in Wisconsin came from investors outside of the state? So please respond A, B, or C. So while we're waiting for that, just as Andrew mentioned, a decade ago we were talking about how do we attract money to outside money to Wisconsin, in Southeast Wisconsin in particular. And we had a panelist of REIT presidents, including the president of CenterPoint, the president of Liberty Realty Investment Trust. And this year we actually have a different set of folks who are actually active in here in the marketplace. And as Dan Meyer said, let's try to figure out why they are here and what brings them here. Is it the market? Is it the higher yield? Is it other things? So with that said, let's see what you all said to this question. So your poll said you have about equal parts, 25 to 50 and 50 to 75%. Based on Xceligent data, year to date, 58% of the 1 million or over transactions were funded by outside investors from outside of the state of Wisconsin. You all are fairly well informed. I would have been closer to the 25 to 50%. So well done. So with that said, I think it's a great time to start right into the questions of the panelists. So I'd like to start with this first question being, first, what is your firm's investment focus, property type and risk profile, as well as why did you purchase in Southeast Wisconsin? Matt, why don't you start us off?
So our two companies is primarily an opportunistic real estate platform. 10 years ago, we were in 100% student housing at Big Ten universities, and in about 2011 and 2012, we were selling stick-built buildings in West Lafayette, Indiana for $200 a foot, and we were seeing 60 a foot concrete loft buildings in downtown Chicago kind of trade distressed, at a much lower number. We said something's wrong with this picture, and we sold all our student housing. And we built a loft office, creative office operating platform in Chicago. And we bought as much of that as we could, and acquired a little over a million square feet of existing product and stabilized it. And then we started to look for other places we could do that. And we expanded to a Midwest footprint, Minneapolis, obviously Milwaukee, and also Indianapolis and Nashville and some other places where we haven't bought anything, but we're actively looking. So we don't do just one thing. We're opportunistic, and I think that the asset that we acquired here was opportunistic in nature, and we view that as a long-term, potentially 10 to 20-year play for us, where we want to obviously make money, but we also want to do the right thing and do something that's going to be meaningful and have a big impact for Milwaukee.
Okay, good enough. Let's go on.
Thank you. Our focus is industrial, and we're chasing yield. We are a privately held real estate company based in Dallas, Texas, and our return requirements are such that we need to achieve, at least underwrite to achieve, upper teens IRR-driven returns over a 3 to 5 year hold period. We've been entering into the Midwest lately. In the last 2 or 3 years, we first entered in a big way into Columbus, Ohio, at a time when that had been actually redlined by many institutional owners, institutional investment platforms. We then moved to Chicago, made a big statement there, and then the opportunity presented itself here in Milwaukee. So we're chasing yield, chasing opportunity. We saw good fundamentals here in the marketplace and an opportunity to get our sorts of returns.
Good morning, everyone. I'm Richard Aaronson. My company's Atlantic Realty Partners. We're based in Atlanta. Our firm is a multifamily development company. The apartment space is very hot right now, which is great for us. About half of our business is in the Midwest. The other half is in Georgia and Florida. We developed our first project in the Milwaukee area over 10 years ago, and then we spent the subsequent period of time really developing primarily in the Chicago market. So we've worked our way back now to Milwaukee. We think we have some great opportunities. We think the business right now in terms of how we're moving into other markets really is driven, particularly markets like Milwaukee, is driven by the need for diversity, for greater value, and it's somewhat defensive. So I think we're looking forward to the next few years.
How's everyone doing? My name's Chris Ressa. I work for DLC Management. We own approximately 120 shopping centers nationwide. So we look to own and buy in the eastern half of the United States, from Minnesota to Texas to Florida to Maine and everything in between. Like some of these panelists, we are also value-add buyers. We have different variations of hold periods, but we are looking for high-teen IRR deals. And I think from Andrew and Mark's point before, about 10 years ago, when they had the REIT presidents up here, one of the things that's driving outside dollar into the United States, or into Milwaukee, excuse me, is that Wall Street is forcing these REITs to invest in top 10 MSAs and to forcing them to not invest in second, tertiary markets, which has created a lot of opportunity for investors like ourselves, in particular us, in markets like this. We've invested in Milwaukee, Buffalo, and places where we can hit our IRR. There's good fundamental macroeconomics, and competition from some of our competitors is less existent than it is in the major metros like New York, Chicago, LA.
Good morning, everyone. I'm Scott Stahr. I'm with Fulcrum Asset Advisors. We're based in Chicago. We're a real estate operating company, meaning we partner with other equity to do our transactions. We're primarily an office investment company. We've acquired 2 projects here in Milwaukee over the last few years. One, a stabilized portfolio of office buildings in the Brookfield-Waukesha area, and then a building downtown at 250 East Wisconsin, which we've acquired with our partner Millbrook Real Estate Company, who's here today. Our investment focus has shifted over the past few years. As I mentioned, we had been primarily a Chicago office investment company, and we found ourselves essentially priced out of a lot of opportunities in Chicago. So we started looking in secondary markets. We did the first transaction in Milwaukee about 3 years ago. Since then, we've done the 250 East Wisconsin transaction. We did a transaction in Madison, and we've done 2 transactions in St. Louis. So we have been, as you've heard some of the other folks say, and I'd echo their comments, we're looking for, I think, more yield than we're able to achieve in some of the primary markets. And we're also looking very selectively among some of these secondary markets to make sure that they each have certain qualities that we like. And Milwaukee has these. It's relatively stable. It's not a particularly volatile market. There's still opportunities. There's a lot of activity. There's been a tremendous amount of civic investment in Milwaukee, especially downtown, which we find very attractive. And in case you don't know, that's fairly unusual among some of these other secondary markets. A lot of the downtown markets in those areas are pretty much moribund. And we've seen something different here in Milwaukee, where there's a tremendous amount of investment, which gives us great comfort that the market's going to continue to perform well. Thank you.
Great, thanks, gentlemen. The next question, and I'll start with Steve on this, is again a 2-part question. You are based in Atlanta, Chicago, Dallas, and New York. Some of you started to answer the first part of this. What other cities are you investing in the Midwest, and how do we compare, is the first part. And the second part is, what is your capital source? How are you funding your real estate investment? Steve, let's start with you.
Well, we're also currently invested in Tampa, Atlanta, as well as the major Texas cities. And we're looking at secondary markets primarily because that's where the opportunities are, that's where the returns are. We have another transaction we're getting ready to close in Atlanta, so we're chasing that market. Atlanta was very slow to recover from the Great Recession, and that looks like, you know that better than me. And so that's been a terrific source of opportunity there. We've been in and out of Atlanta several times, actually, and the latest, we're getting ready to close a large transaction there at the end of December. What was the other part of the question?
Capital source.
Our capital sources, we've migrated over the years, over the 20-something years we've been in business, to institutional private equity firms as our major source of equity. We co-invest in every single transaction. We have a strategic joint venture right now with Partners Group, which is a Swiss-based private equity firm with a worldwide footprint with $40 billion under management. We have several other private equity firms that we do business with, and that's our major source of equity. And we co-invest with every opportunity.
Great, thanks. Richard?
So in the Midwest, we're primarily, most of our work, as I mentioned, is in the Chicago area, and somewhat now to a greater extent in Milwaukee. I think we probably would consider Minneapolis. We've looked at that. For a development firm, it's more difficult to jump into a new market. It requires a lot more expertise, much greater investment of time and effort in building an organization. So we're fairly careful about expanding from point to point. I think it's easier when you're doing asset acquisitions. But as it relates to our capital sources, our firm is essentially a family office, and then we co-invest with institutional partners. Our partners are wide-ranging from insurance companies. We have a joint venture, for example, with Northwestern Mutual in the Atlanta area, and pension advisors, private equity firms who do a lot of business with Carlyle Group out of Washington, D.C., and then we also do a lot of business with other family offices, predominantly on the East Coast. We do programmatic work with some of our investors, but really most of our projects end up being one-off. But we have a pool of great co-investors that we try to keep doing repeat business with.
So our capital source for equity is internal as well with, we have high net worth individuals that we partner with, as well as institutions, private equity, and pension funds. So it's a varied platform. In the Midwest, we are in Milwaukee, as you all know. We're in Chicago, St. Louis, Columbus, Ohio, and we're in a lot of markets that are, have similar fundamentals as Milwaukee. We're in Buffalo, we're in Lexington, we're in Nashville. So we're in a lot of markets that are very similar. The biggest challenge for us in those markets in finding opportunities is we're looking for deals of size. So based on our platform, in order to grow, we can't really spend time on deals that are $2-3 million deals. Our minimum deal size requirement is $20 million, and that's small for us. As Andrew noted, our deal in Milwaukee was $47 million. Our last acquisition was in Chicago suburb that was $120 million. So we're looking to put out $300 to $500 million a year, but you can't put that out if you're spending your time on $5 and $10 million deals. So in these second and tertiary markets, it is difficult to find deals of size, especially for us, because we're not in the development game, we're in the buying existing game. So I would say that, we really like the markets, but that is one of, especially the opportunities to get to our IRR, but the biggest challenge is finding deals of size.
Similar to a number of the other panelists, we capitalize our transactions on a one-off basis as well, going to a pool of private equity and institutional equity to provide the majority of the equity investment in each transaction. I alluded previously to some of the city's other secondary markets that we've transacted in, that being St. Louis, Milwaukee, Madison. We've also and are continuing to look actively in some other Midwest secondary markets, and you've heard some of their names: Columbus, Cincinnati, Indianapolis, Minneapolis being the primary focus. Was there another part to your question, Mark?
That is both capital markets as well as which markets you're investing in, which you got. Great. Matt, do you want to wrap us up?
We want to fit the capital source to the project. And so with the post office, for example, we have a discretionary middle market fund that did part of the capital stack on that. And then we partnered with a family office based in Chicago that has a really long-term view, 10-plus year view on the hold period With what we've done with Creative Office, you're talking about a lot of smaller deal size and smaller assets. There aren't a lot of large Creative Office institutional size assets. So we bought them with opportunistic capital and with our own balance sheet, and then as we've aggregated the portfolio, we're now seeing institutions come into that space, and we're predominantly partnered with Goldman Sachs on recapitalizing those properties.
Great, thanks guys.